Happy Friday, everybody. Good morning. Welcome to this week's long-form episode here on Mining Stock Daily. I am back in studio to present this longer episode. In fact, we had a chance to touch base with Paul Gurney over at Beacon Securities once again, as I always like to do when I get some time in London. And so this conversation with Paul was actually recorded earlier in the week, but given the the market moves here, so the last couple of days, the conversation still holds true and is timely. So great conversation with Paul. As always, we cover a lot of ground, specifically in precious metals, including platinum and palladium. Special thank you to Revival Gold, Integra Resources, Caliber Mining, and Visa Silver for the continued support of Mining Stock Daily. And we'll get this long form episode in for the weekend. Happy Father's Day, everybody out there on Sunday who celebrates. All right, man. All right, everybody. Have a great rest of your weekend. Be well. All right, everybody. Welcome back into Mining Stock Daily. It is Monday morning, London time, and no trip to London is complete without a trip to the lovely St. Pancras International Train Terminal, which means we welcome back in our good friend Paul Gurney, Beacon Securities, and also the author of the Morning Gurney Game Plan, which, God, I just love reading. This is turning into be our go-to spot for these interviews. Paul, it's good to see you this morning. Thanks so much for doing this. How you been?
Likewise. Always excited to come back to the station and see you. So thanks for coming through. And commodities are ripping. It's a good time to be alive.
They are ripping. I don't know if anybody coming off this, these trains, from Brussels or Paris realize that commodities are ripping. But you and I are going to talk about it. So when they look at us with the headphones on and what are those guys podcasting about, then they can go do their own digging. You had, we were kind of going back and forth in text messages and DMs before this, and you wrote to me and said, I am really bullish commodities. I mean, that's kind of your job to be somewhat bullish commodities. Yeah. But I think just the tone and just the excitement coming through that was showed you it seems like we're in a special place now.
I think we're in a very special place, and you're right. Okay, it's my job to be bullish commodities, but not my job to be bullish all commodities at the same time. Okay, so I mean, the reality is where we're at right now is we've had years of underinvestment across many different commodities, which we've talked about. So silver, platinum, rare earths is getting a ton of attention right now. So you've got supply side constraints, which this isn't. You can't just wake up one day like Trump and say we need rare earths. Let's build a mine.
We'll just go. We'll get them from Ukraine.
So there's a time lag on these things, and putting aside permitting, right? Like even if you green light permitting, what we're doing with the uranium projects, they still take years and years to build. So if you're in a situation where you're supply constrained, you're gonna have a squeeze, right? So high price wins. The more interesting piece, which has just started to really come through, is U.S. dollar weakness. So when Trump first got elected, the U.S. dollar went the other way. It went strong. Everything sold off. But in the last month to two, you've really seen this acceleration in the depreciation of the US dollar, and that's for various reasons, right? Which is beyond this podcast, but I don't see that reversing for the rest of the year. If anything, I see US dollar weakness is going to be even more acute as we go into the end of the year with US debt issues and what's going on in the US right now. So if you've got a weak dollar, that's always like a huge bullish sign for the commodity. And then just lastly, the commodity prices are responding. We're seeing the spikes. We've seen a spike in silver, which we've all talked about for 2 years, but it's finally happening. Platinum now is spiking. Gold remains pretty healthy. Copper remains at record highs. So you've got amazing prices for the producers. And so across the commodity complex, what are the producers doing? They're not building new projects yet. They're investing small amounts into the juniors, which is why we've seen this uptick in the juniors. So it's a great setup. I don't take it for granted because it can end just as quickly as we got here, but I think there's a lot of longer term things here that'll play out over the next 6 to 18 months that are quite bullish for the whole sector.
Now, we're going to kind of dive into each one of those metals one by one here over the next few minutes. But let's start off, and we got to talk about gold because it has been correlated with moves in the US Treasuries. So more sell-off in the Treasury market as yields rise. We've also seen gold rise as the kind of safe haven place to go to, as there's a lot of concern about the US fiscal
issues and debt problems. The tax bill that's kind of now in the Senate looks to be adding another $2.5 trillion to the federal debt. But that has kind of, I mean, since Treasury markets has cooled, gold has also kind of cooled. It's just kind of been, I guess, mostly flat, I guess you could say. But is this kind of like, an easy way to trade it? Like watch whatever the Treasury market does in the U.S. and so goes gold?
Pretty much, right? I mean, it's multifaceted because central bank buying from the rest of the world has obviously driven price higher. But like my view on gold is it's come a long way in a short period of time.
Yeah.
And even this year. So we went into this year and most people weren't even forecasting $3,000 an ounce gold. So it's moved rather quickly. A period of consolidation is a healthy thing. It's very healthy. So the reality is it's probably range bound from here on out, at least for the foreseeable future. We had the super spike to 3,500, then it's come back down, but it's still this price for producers. They are minting it.
Yeah.
They are making an enormous amount of money.
Yeah. Hey, you talk to a lot of funds, a lot of institutional generalist funds, deep pockets. Are people starting to finally come around to this sector? Are we seeing them allocate more capital to the gold miners?
I would hope so. The broader issue is just when you look at the GDX, it's actually seeing outflows. So the risk of the sector is that people use it as a source of funds. Whenever you have something that's done really well and you've got volatility in the market, what's the first thing you sell?
Yeah.
The thing that's done best, right?
Right.
You loss aversion, you hold on to your losers, you sell all your winners, right? So that is what we've continued to see in the sector. And from being around the gold miners for 17, 18 years, I think there's still the skepticism that they're not going to spend all this money on a copper gold porphyry in Argentina, wherever, right? And that's what happened in 2010, 2011. We had these mega projects that were $5-6 billion, and all that free cash flow ended up being, capital calls. So I think there's still a reluctance, but on the generalist side, it would be great to see more of that investment come into the sector. And I think as you get the metrics, the free cash flow yields and the PE and all that, I think it screens well to look at it.
Yeah. You kind of mentioned it beforehand, but what are the gold producers doing right this go around? Early days in this market, in this bull market, but what are they doing right now, or doing correct now, that maybe shows you that they corrected their errors from the last cycle, 2011?
I think that my theory on this is simple, right? So the institutional memory from all these senior gold CEOs is still there. They understand what happened 10 years ago. But if you, and I don't have this number to hand, okay, but if you look at the average age of the senior gold CEO, I'd be willing to bet you it's on the higher side of 50, like 57, 58, right? It's not 48, it's not 50. And so go cast your mind way back to like 2009, 2010. Aaron Regent became the CEO of Barrick. How old was he? He was 40, right? So when you're 40, are you thinking like, I'm not going to do anything spectacular. I'm just going to run these assets for cash and buy back shares and raise a dividend. That's really exciting. No, you're like, I want to buy something. I want to build something. I have to build my legacy, right? I think for a lot of these gold CEOs, they have these amazing assets. They're throwing off cash and they're just like, I've got 2 or 3 years left to run in my job. Like, why am I going to build a mega project that's going to take 10 years? That's just downside. That just sucks up cash. Shareholders want me to buy back shares. So I'm going to buy back shares. And no one's going to criticize me for that. No one's going to say, Trevor, why aren't you buying more things right now? Shareholders don't want them to buy things. So I think it's just job security, to be honest. I think a lot of it's job security. And last time they tried to build the mega projects and they realized how difficult it is. Gold is difficult.
Yeah.
Right?
What about special dividends? So is that something that might be on the table, or do you think most companies are just going to stick with the buyback program?
I think they'll just buy back shares. I think from a tax efficiency perspective, I think people prefer that.
Yeah.
So, and that way they can issue shares when their stock goes up and they want to buy something, right?
Well, okay, so if these miners are minting cash, buying back their shares, I guess, what they tried to do in the last cycle is buy these mega projects that just didn't work out very well. So now we do have these mega projects, these large capex projects in Argentina and Chile.
Yeah.
Who's gonna buy those? We already seen Filo come off the block. Like,
yeah,
there's some other ones out there that look pretty dang large and juicy, but who does have that 10-year timeline to get something built?
I just don't see the risk appetite, because when you're making amazing returns, where's the incentive? All right, I don't see it. I just try to put myself in their shoes. Like, why do I need to take an enormous risk? Because buying a project, building a project, and I was on a site visit last week, and someone said to me, like, building mines is hard, difficult. It's not fun.
Yeah.
So once you have a mine, and I was like Ivan Glazenberg said, once you have a mine, just run it.
Yeah.
Just run the mine for profit, and why bring on new production?
Yeah. All right, let's take a step away from gold and talk about some of these other metals, specifically PGMs and silver. We had that massive breakout in silver last week, went north of $36 here. And I'm looking at this thing, Paul, and I'm like, we knew it was going to happen. It was only a matter of time, but this looks more of just like a technical breakout than it does on anything fundamental in regard to supply. Is that the best way to look at this?
I think so, yeah. And it's like I kind of said on the US dollar weakness, we've been talking about silver tightness for 3 years.
Yeah.
Right? So does it go to 50? Does it go to 100? Like, there's no reason it can't. Does it go back down to 28? It can.
Yeah.
It's like, I know that's not helpful.
Well, I mean, the silver equities started moving. I mean,
Yeah.
is that the easy money, I guess you could say, has been made, but it seems like this probably has legs if you're talking.
I mean, if you look at a silver price of 40, let's just use a round number. Like, everyone's making money. All right? So even fourth quartile, Mexico, small scale production's making money. So it's a very good price. So we haven't really hit that phase where everyone's making money, can expand production and do this and that. So I think it's still early days in silver. And people quote the gold to silver ratio, which honestly I just think is just a number. I don't put any magic in this ratio, but it's under 100 again.
Yeah.
And historically it's been much lower than that. So the compression can happen, but that also means gold can sell off, by the way. It doesn't mean silver has to go up. So yeah.
What about the Mexican producers, silver producers? You like Mexico? We're still waiting. I just talked to Doug Ramshaw this week, and so we're trying to figure out, the lay of the land. He really feels that things are looking good for Mexico, that there's going to be some policy statement made out of Mexico regarding mine permitting, and that will provide some clarity. Like, how do you feel about Mexico right now as a jurisdiction?
It feels to me like waiting for Godot, that comment you just made, because I've heard that for 3 years. Is that the Mexican government is very pro-mining, and they're going to overturn the ban on open pit. They're going to give more clarity. So I'm hopeful that happens, because I talk to the same groups of people you do and producers, and there's a massive and impressive mineral endowment in Mexico. But until it happens, it's hard for the investment community to get behind it, because for now it's just been waiting and waiting and waiting. And there's other areas they can go, right? So Argentina's really opened up as like a silver district now. There's some great opportunities there. So I think it's still wait and see. And on the political risk side, I think people are more antsier than ever, because, whether it's Africa or Mexico or wherever, it's like, if you can't get your money out or your mine's going to get taken away from you, it doesn't matter what the value proposition is. So I think assets in Canada and the US have become much more attractive. In particular, if the permitting regime changes, even if it improves slightly, I think relatively these assets look better.
Yeah. What about assets? Assets in the US with a little bit of permitting change under this administration? How do you feel about US?
No, I think you bet. I think anyone would love to build a mine in the US if they could, right? If it didn't take 15 years to permit.
Yeah. Well, I'm hearing news. I think that's happening pretty quickly.
Yeah.
We're getting a little anecdotal news kind of dripping down a little bit, but I feel pretty confident that U.S. precious metal assets and critical minerals assets, obviously because of the race there, that, I mean, they should maybe be trading more at a premium than they already are.
Yeah. No, for sure. And mining is such a small part of the overall investment community, so a lot of people don't have their eyes on it. But I think the last 6 months, 12 months have really focused the broader investment community on how important it is to have your own supply.
Yeah. All right, let's move on to something you've been pounding the table on a lot, and I would love to provide me some clarity on platinum and palladium. When these metals broke out, what was it, 2 weeks ago now? Was it 2 weeks ago?
Yeah.
Lost track of time.
About a month ago.
About a month ago. All right. I mean, both of them ran up over $1,000 an ounce finally. And I was searching around, like, what on earth? Why? Like, I couldn't figure out why these metals were breaking out. But of course, I had to turn to your writing on the game plan and get a little bit of context. So can you break this down?
Yeah.
You know, what took so long for platinum and palladium to kind of do this? What forces were keeping them down beforehand? Was it just no need for internal combustion engines? Is it just fundamental?
So all the data I've got, by the way, is from the World Platinum Investment Council.
Okay.
I have a good former colleague of mine, friend Ed Sturck, who does a lot of the work there, and he and then you can go to their website and get all their data, and they do amazing quarterly reports, and it's it's phenomenal data. So essentially, the setup is this, right? Catalytic converters need platinum. We're all moving to EVs, so we don't need catalytic converters anymore. So therefore, platinum's a dead metal. That's been the bear case.
Yeah.
What happened in COVID basically is we ended up with too much inventory because all the auto producers bought the platinum palladium they needed. Car sales went through, collapsed, and then we were left with all this inventory that they've been working their way through. Right. So that's the negative. The supply side is because the South African producers, which is the most of the production for platinum is out of South Africa, because they've been undercapitalized for the better part of 15 years because the price has been so low. All these mines are high cost, they're creaky, they need repairing, and they're not going concerns anymore. They're losing money. They should be shut, but they're not, right? And a lot of them have been shut, but they're not making any money. So you have an industry that's undercapitalized. People think it's dead. So the bull case is what? Well, we're not transitioning to EVs as fast as we thought. There's actually a lot more plug-in hybrids which still use platinum. And then on the supply side, we've had 3 straight years of deficits in platinum on the platinum side. And then, so that sets up a situation where, okay, demand is flat, but supply is going down by 3 to 4% per year. And so we've all talked about this squeeze coming. And last year, it was too early, it was banging the drum on it. But in the last month, it started to happen. So the price has gone from $950 to over $1,200, which it hit this morning. Lease rates have gone up, which means people are really short current material. The commodity curves in backwardation, and prices are moving. So it tells you there's a squeeze somewhere. Is it longer term structural? From all the stuff I've read from the World Platinum Council, it is long term structural because no new mines have really been brought on.
Right.
And there's not a lot of ways to play platinum, right? So it's like you've got the producers in South Africa, and then you've got a number of project companies who haven't been able to fund the projects because why? Because you've had a platinum price that's been below $100, that's $1,000, right? So the setup looks pretty interesting because it's happening. And I've talked about the last 2 weeks, but people are still like, we'll see if this lasts. Mm-hmm. There's been a few false dawns, as someone said to me this morning. So I take that, right? Like, the market can squeeze and go back down again. But
I did read, it's maybe just a little anecdotal, small in nature, but as the gold price is running up, more people are turning to platinum for substitute of gold and jewelry.
Yep.
So, I mean, it's probably not much, but it is something, right? I mean, it just kind of shows you, like, people will find a substitute with something that's too expensive.
Yeah, 100%, right? For certain things, like if your wedding band, instead of gold, platinum's a third of the cost, right?
Right.
Why not?
A platinum ring with a fake diamond. You already got it.
Pretty much.
You already saved 80%.
Yeah, exactly.
Well, that's really fascinating. So how do you see this thing kind of playing out? Is it like a kind of a trickle up? I mean, you mentioned potential for a squeeze. I mean, does this thing have exponential potential?
It's squeezing right now. I mean, it's up, 3.5% today. It was up 3.5% Friday. Someone's short material right now, and they need to get it. So, this isn't a 20% move in a month, isn't a squeeze yet.
Yeah. Opportunities in this area as far as like leveraging with miners. I mean, I'm thinking, Siboney in Montana, a couple other explorers in that same area. I'm thinking Magna Mining up in, in Sudbury area.
Yeah.
They have a nice endowment of PJMs.
Yeah, no, I think for any of these commodities, once the price runs, the preference for people is producers and cash flow.
Yeah.
Right. So if you've got production and cash flow, that's what people want to own in general. And on the project side, they're more reluctant.
Yeah.
Right. Because projects, 10 years, 5-10 years till you get stuff out.
Well, are those companies making money now at $1,200?
No,
Not at all. What's that break? What's that cutoff?
I don't want to actually throw a number out there because I don't know it. I think like 1,200-1,300 is kind of the number, but yeah.
Yeah. So let's get back to this feeling excited about the general metals market. We had a discussion last week, and I titled the long forum, it's like, despite the bull market, everything's very uncomfortable.
Mm-hmm.
And we've been here before. We know there can be a rug pull at any time. What is the headwinds, or like what could potentially be around the curve that like really is a gut check for us resource investors, and that's still kind of like festering in the background?
Well, it's just recession.
Yeah.
I mean, the big R, right? By the way, no one's ever predicted a recession in the history of mankind. So, if people are predicting recessions, I'm actually like way more bullish. There's a train leaving for Paris. Bye-bye. It's recession, right? Because that's where the demand side comes off, and these supply side shocks. I mean, that's the risk. The risk is supply side shocks causes a recession, right? Because if price spikes, then demand suffers, right? Like price doesn't go up forever.
Yeah. Well, what are your thoughts on recession? If you're looking at copper's not screaming recession.
Dr. Copper is saying it's game on, right? It's game on in China. I'm looking at US, UK, Canada. It's like, it looks like it's a recession, but if I'm predicting a recession, it means it's probably not a recession.
Yeah.
So,
well, I think especially in the US, we talk about all this debt, and there's a number of ways to handle it. Obviously we've continued to talk here about potentially inflating it away. That's scary to think about. Mm-hmm. But the other one is like really just spurring growth and doing everything you can, whether it's like meaningful growth, in a way that naturally happens, or if you are pushing things in a way that it's, looks bountiful on the cover of it.
yeah.
So I think that's still up for debate in which way we're going, but it definitely feels like governments are really trying to push growth, because that's what they've always done for the last 100 years. Growth will always protect us and be our saving grace and get us through the bad times.
Yeah.
Now we have growth priorities on the back of artificial intelligence, data center. I'm hearing news about pipelines being already tapped on the sides, and specific places in the United States being prepared for more data center build-outs and producing energy for those, which is quite interesting. So that obviously means a lot more resources, a lot more energy is going to be needed to go on this. I mean, as you look at that artificial intelligence type, blue sky potential, how much thought are you putting into that? Is that playing into your thesis at all?
For the macro side, the thesis I put into it is just broader support for mining.
Okay.
Because that's been the piece for the last 20 years, 30 years. That's been the challenge for mining. It's been building mines. It's been getting the social license to build mines.
Yeah.
So if the broader public gets the understanding that, okay, building out a nuclear power plant actually is much better for the environment, because then we don't have coal, we don't have natural gas, and actually it's way more efficient than wind and solar.
Yeah.
Then they understand, well, the uranium plant takes uranium, so you need uranium on that, right? And it's the same on the copper side, right? So if we're all gonna have robots in 10 years that do everything for us, right? Like, where does the metal come from? So I think this crisis in the last couple of years has woken people up, because I know in the general conversations I have, when people always ask me, what do you do? I was like, well, I raise money for people to build mines. And they're way more fascinated about it now than 5 years ago. And it's like, well, that's bad for the environment.
To the gallows with you.
Okay, I guess we'll just make stuff out of dreams, right?
Yeah.
But so on the macro side, that's really where I see it. It's just like, the fact that these tech companies, once they take something up, they're like, sacrosanct. Everyone's like, oh, the gods of Microsoft have decided nuclear's the way to go, therefore we go, right? Whereas for years, the industry's been fighting for 40 years. Since, the 70s, 3 Mile Island and all that, right? Like the industry's been in the doldrums for 40 years. And now all of a sudden we're hungry for power again.
Yeah.
And how do we get that, right? So, like, I think, again, talking in my book, and maybe I'm too optimistic and too bullish, but I'm like, this electrification theme, the fact that we need more of these specialized metals, the fact that we're still growing, right? All of this speaks to having to build more production.
Well, the fact that we're going to need more energy, we currently don't produce enough energy to fund whatever it is that's on the horizon, which we know isn't going to stop. We're not going to stop.
Yeah.
It's just the next part of societal growth, I guess you can say. And I don't know, maybe I'm answering my own question when it comes to that growth outlook. I think that maybe that is the best case scenario for handling all the issues that we currently have. Time will tell.
When you go back to something else, though, like we talked mega projects, right? So I like to put the little context. So London, when I first got to London, early 2010s, they did this huge project called Crossrail. So they burrowed underneath the 2,000-year-old city and built a tunnel and built the Elizabeth Line. It's called the Elizabeth Line now. It was the biggest infrastructure project in Europe. The final price tag, I think, was 19 billion pounds sterling. So what's that? 26 billion US, right? Mm-hmm. Massive infrastructure project. I'll be paying for the rest of my life because our tax dollars paid for it. Now you look at these big mines, right? These are massive projects, right? So like that Philo BHP mine, what's the price tag on that?
A fraction.
Is it 10 billion, 12 billion? Like, we like to think these mega projects cost a lot, but in context, they're like, that's just like saying, let's build a new subway in New York, right? What would that cost? 20 billion? Like, right. I don't know. I just throw that out there. So I just say, like, somebody still has to fund these things, and it's not governments, right? And there's only so many big mining companies that can actually afford to build these things.
Mm-hmm.
So there is a real supply issue on the bulk commodities like copper. There is a huge supply issue because the copper mines right now, where are they? They're in places we don't have control over, right? Yeah. Countries in Africa that politically stable, unstable any given day of the week.
Yeah. Let me talk to you about the kind of breaking down the major resource markets. I'm thinking, jurisdictionally, Australia, Europe, London, US, Canada. I actually read that a couple days ago that mining equities outpaced everything on the London Stock Exchange that day, and I was like, it was so random, because it never happens, right? They're just super small. There's nothing to them on the LSE. In fact, I think the reputation is that there's nothing good. There's no good mining equity on the LSE. But it was kind of interesting, a headline to read. And you work with a number of different markets, a lot of different companies trade all over the world. What are you seeing here if you break it down the major markets and kind of the response here for resource stocks?
Let's start Australia. Like, Australia has traditionally been a strong resource market, continues to be. A market that's been backstopped by the superannuation funds. Australians have done very well exporting to China. They get it. They understand what they're looking for in a project. They want, quick return. They're pretty impatient, and, they don't really like waiting around on an exploration project. And it's a healthy market. It's been a healthy market to raise money in for a few years now. London, to your point, coming into the one in the middle, is, as a market, it's a bit more risk adverse. Yeah. Strangely, for some reason, people think London is very risky, but it's not. Like, actually, the pension funds in London or in the UK hold way more fixed income than equity, and they should, right? And it's really dragged on their performance. But for whatever reason, London's been this risk adverse market. But the one place where they have been, kind of risky is the AIM market and mining stocks. But those have been such a underwhelming place to be for so long.
Yeah.
That you look at AIM, it's a wasteland of names, right? So to your point, this little, uptick in like performance, generally that's what attracts people, right? Like they don't like to be the first person there, but if all of a sudden things are going up, they're like, maybe I should look at this again. So, to have a healthy London market from a capital markets perspective, you need mining to work, because as you know, mining's short cycle. These companies need capital all the time. And so I'd be interested to see in London. I have my doubts.
Yeah.
Because, I'm in the market, right? And I'm just seeing like the last 4 or 5 years how like negative everybody is. But again, contrarian signal. Maybe that's the sign that this is the place for companies to be again. And then Canada is just similar to Australia, right? It's always supported a resource market. TSX is like the world's, best market, most renowned, deepest, most liquid. Tends to be more of a gold market though.
Yeah.
As opposed to the others, right? There doesn't traditionally tend to be a lot of copper options or other options on there. So it's been primarily gold market. But all these, like, if you look at the TSX, it's on all-time highs right now, which no one talks about, right? Like,
the chart doesn't look as bad.
No. And so you look at it and you're like, well, why is it at all-time highs? It's like, well, there's a big component of the index is gold names, right? So this is what I was saying to you before we met, before we got on here. It's like, I'm pretty bullish on the commodity space right now. Like, not just from a pricing, but from the fact that I think this momentum can continue.
Yeah.
Because you do not have, it's not a big sector. So any flow of funds into it has an outsized effect.
Yeah, it's meaningful.
Right.
We've talked a lot about the repatriation of capital out of the United States and coming back to domestically. Have you been noticing that here with UK funds, people you're talking to at all?
Like onshoring into the UK and like not investing into
pull money out of the US.
Like a bit. Like, so the trade here has always been for a decade since I've been here. European equities look really cheap. You should rotate out of US and rotate into European indexes, right?
Yeah.
And it's never worked. It's never worked. So broken clocks, right? Twice a day. So, you've seen some of that this year, but the reality is for people who are more, generalists who are investing in tech, like where do you find the best tech companies in the world? There's a lot in China, but a lot of them are in the US, right? So, yeah.
Your company, or not your company, your employer, Beacon Securities, you've done a lot of some pretty good deals here as of recently. Give me a sense of where we're at as far as, capital coming back into exploration development plays.
Yeah.
It's mainly traded in Canada or the United States.
Yeah.
Seems like there's a little bit more willingness for people to start allocating to riskier positions.
Yeah, 100%. So the thing on exploration is, let's say if mining's niche, then exploration's the niche within the niche, right? It is. It truly is, because it's a VC model. I've always looked at exploration as VC. Like you have to look at like 50 of these things you have to be in. You can't just pick one, right? Like the odds are against you just trying to pick one. So you have to like build a portfolio. But in terms of exploration, what's really helped is the liquidity and the market caps of these things have gone up. And most institutional investors, actually most if not all, have liquidity and market cap thresholds. So if you're below 100 million market cap Canadian, say, like, no one can look at you. It's retail only. So as the tide has risen and the market caps go higher, it means, they're in an investment universe where more institutions can look at them, and they're coming in.
Yeah.
And because their portfolio is going up and they have more capital to deploy, and we're definitely seeing that. Yeah. Right. The liquidity is still an issue for a lot of these names. Like, they're trading 10,000 shares a day. Like that's not great. But on the equity raising, on the financing side, that's what makes it more compelling, because if a fund wants a position in, junior XYZ, the only way to get in that oftentimes is through a financing.
Yeah.
Right?
What's moving the needle for retail to come in? Marketing? Is marketing number one?
I don't deal with retail, so I couldn't. I mean, out of my my skill set.
I like to think that you help kind of set the platform to help do those financing, bring meaningful capital into these companies, and once that's kind of announced or picked up, the people that cannot participate in those financings maybe are forced to go buy on the open market to try to play with the big boys.
Correct. So, I mean, you summarized it nicely. You put a layup there for me. So, like, no, essentially that's what I pitch to companies, right? Like, what do we do? What do I do? What do we do well? What we do well is we help you move from a retail investor base to an institutional investor base.
Yeah.
That's what we do. We only deal with institutions because there is that transition that has to happen if you want to grow your company, because retail has a limited amount of firepower. Retail can seed you. They can put a few $1 million into the company. They can get you those first drill results. But when you need to do a study, when you need to do a PEA, when you need to do PFS, when you need to do a 100,000 meter drill program, you can't raise that in a retail market. You can't raise 25 million. So you need like 2 or 3 institutions to help you do that. The thing that I've seen as of late is it appears there have been more retail dollars supporting more kind of formation stage companies to help them do that first set of drilling to make it interesting or more appetizing for an institution.
What you kind of laid this out there nicely, but my follow-up question is, okay, you're at your desk and a company comes to you and says, Paul, we'd love to get in front of more institutional investors. What is like a couple things that you that this company has to show you? Not just market cap, but has to show you for you to even consider maybe, pitching that to your colleagues as something you should pick up and cover and help.
Yeah.
Help cover. What's most important?
Totally. Like, there's 3 things. It's like, and I say the same thing. It's like, first off, like, make sure you have an up-to-date presentation that looks professional. Yeah. I mean, and it's honestly, with AI tools, everything, there's no excuse for it.
Yeah.
Right? Like, I'm horrible with PowerPoint. There's tons of stuff you can use now.
Yeah.
So, and just look at the way everyone else structures it. Like, it's pretty simple. Like, put up front, cap structure, where your project is, and then go into it. So it's just that. Mainly, though, it's management. It's people behind the company. Because, it's this sector's not very big.
Yeah.
So there's a bunch of people who have been successful who people will always back. And they're like, oh, that's a Lundin family company. They're like, oh, Lundin family company. They know what they're talking about, right? So not every company can be a Lundin family company, right? So it's like, who's your team? What successes have they had? That's what I'm always looking for, right? And the industry's filled, like, I get it. It's a high probability of failure industry, but where have you done well across there? Always looking for that, because that's easier to back. And then just lastly is, how is the company capitalized, right? What's the share structure look like? Is there enough upside? Is there enough juice for the next person coming in? Or is your valuation already so high with 5 drill holes that there's not much for the institutional investor, that they're like, this isn't worth my time?
Yeah.
Because the reality is from a risk profile, if there's a 5% chance of success, right, then someone needs to have a return that matches that level of risk. And if it's just a 20% upside, it's not compelling. They can just buy Shopify or buy something else, right? You know what I mean?
No, that's a good point.
Yeah.
You kind of posed an interesting thought, and this conversation I actually had in Frankfurt with some people. But when we talk about, investment or speculation thesis with a specific company, and we always talk about, oh, you want to see prior success. You mentioned the Lundins. I mean, there's a whole list of people with generational success out there. Not just the Lundins, but obviously the Friedlands, the Beatties, the McEwens, and they don't have their premium to that right now. They're always going to have their premium. But where is that next generation of success going to come from? That greenfield success that comes out of nowhere. What do you see on the horizon that maybe when we're retired and drinking margaritas on the beach, they were like, oh man, I'm so glad I invested in that young geologist turned financier that just knocked it out of the park for 30 years.
There's an amazing thing happening in mining right now, and that's, we always talked about the aging out of the older generation.
Yeah.
And listen, we want them around for as long as they're here, right? We don't want anyone to leave. But the fact is you've got a generation that's older, and a younger generation that's coming along. And there's some really, really exciting young geos that are coming along. And I'll always give a chance to that person who's like really enthusiastic, and it's their first project, and they're giving it a good shot. And they've got a good team around them. And there's countless examples of that right now. Of people like you look at like a Scott Birdall from Snowline, right? Although those projects were in the family for years and years and years, like he put the package together and went around and you know, went and got the money to do the drilling, and that's one of the biggest discoveries in our generation, right? So there is a next generation coming along. There's the next family of you know, generational wealth that's coming along. Always looking out for those. It's tough to identify in advance who they are.
But where do you jump from, you know, an incredible geology success with a project and selling that off? Where do you jump from, you know, doing that to like being the big financier, the promoter, like number of potential tier 1 projects within, you know, under your wings? Like where's that generate?
It's well, what do we call, what's the triple threat in acting? Is it acting, singing, and what's the third one? Dancing. I don't know. Which is kind of, I don't know. That's neither here nor there on that.
Timothy Chalamet. Timothy Chalamet of junior mining.
Yeah, basically. But for mining executives, I get this. I hear this quite often, right? Like where you talk to a CEO, they're like, "Oh, I really hate marketing." I'm like, I can't imagine anyone ever saying that as the CEO of a business, because you're the salesperson, you're the marketer. Like that is literally, most of your job is marketing.
Yeah.
Right. But I get what they're saying. They're like, I don't want to be promoting a piece of moose pasture in Flin Flon. Right. They're like, I want to have a great project. So it's like, everything has to be married. You have to have great geology. You have to have someone who's really good at telling the story. Right. And then you have to have someone who's really sensible on the financing side. And that does exist. Those people do exist out there. And that's when you bring all that stuff together, that's when it really hits. But you can have two of those things, and then you can kind of add the finance cap markets person, right? Like that's always the potential. But what you can't have is just the person who shows up in this presentation with 17 geological maps, and you're sitting there and you're looking at this fault structure and that. You're like, just let me know where you're going to drill, how much it's going to cost, and when the results are coming out. Yeah.
What are some specific stories you're really looking for here this summer? Drill programs or development stories? You know, we're back on the, you know, in the north, we're back on the ground. Exploration teams are back at camp. Anything specific you're really excited to see?
I think there's tons of interesting things out there. Like, I think assay labs are going to be busy. Like everyone in Canada in particular, with this flow-through regime, a lot of companies have a ton of money to do drilling. So I think things in the Yukon are going to be interesting.
In what way? In Snowline?
Yeah, no, I think Snowline, Sick out there. I think Quebec's interesting. I think all these places, because Canada again has become attractive, and I don't think everyone's picked up on this yet. But with everything going on in Western Africa right now, everyone's like, okay, the stuff that used to be low grade in Canada, now that gold is $4,800 an ounce in Canadian dollars, actually looks pretty attractive.
Yeah. What about opportunities for more developers who are in that, you know, PFS / permitting potential project financing? Are there any opportunities still remain for them to acquire producing assets to help fund them through that process?
I think so. I think for sure, you know, like 6-7 months ago, there was a trade there to buy producing assets. I think, you know, in the conversations I have with people is they're always in the market for producing assets. The issue now is the offer's gone too high. So it's the price is run. So you and I are sitting down to, let's say I'm going to buy a gold ounce and gold project off you for 50,000 ounces a year, 10 years production. What was that worth a year ago? Well, a year ago we were using $2,000 an ounce long-term gold prices. Now we're using $2,750.
Are we using $2,750?
$2,500, whatever. Exactly.
Sure.
See, we can't even agree. We can't even agree in our.
Well, the last I saw, like I've seen a lot around 22.
Yeah.
You know, that's just kind of been based on like moving averages
Yeah.
historically, but
Yeah, well, point being is in this
close, right?
hypothetical example, you and I are going to sit here for 2 hours and debate what the gold price should be that we're going to use for the valuation.
well, do we get paid to do that? Like the rest of the
No, it literally anybody who makes these acquisitions in commodity tells you, like, you know, if you buy a mine that's been mismanaged and you fix it, that's great. You know, you can make money regardless of the commodity price. But the reality is, if the commodity price goes up, you look brilliant, and if it goes down, you look stupid.
Yeah.
So, us negotiating that price, that long-term price, is the entire negotiation. So, you know, when the price was stuck at 1850 and everyone, you know, things could get done, now you've had this price rip, and you're like, well, I don't want to sell this too cheap. And you're like, I don't want to buy it too expensive. So you sit and nothing happens.
Yeah.
And it'd be really difficult for a PFS stage or feasibility stage company to go buy a production asset that didn't have some hair on it,
Yeah,
right?
yeah.
It's broken or it's not operating or whatever. That you can still do. But again, if it didn't work before,
Yeah.
why is it going to work now?
Well, if we're getting paid by the hour to have that debate, then we can talk for hours and hours and hours, and maybe even days. Paul. All right, wonderful. So here we are. We're almost mid-June already. There was that old saying, "Buy in May and go away." It doesn't really seem like that's the game plan here. Like, you need to be pretty active here if you want to capitalize. Like, there is opportunity within this market within the summer months.
I've always found the summer to be very fascinating for markets,
Yeah.
in particular in the liquid stuff, because there's always something that happens in like July or August,
Yeah.
and there's opportunity, right? There's always opportunity. So, like, you can't sell in May. Like, what, you just sell your whole portfolio, go to cash? Like, the US dollar is going to be down 5% the next 6 months, right? Like, I don't know. So you stay invested, but I mean, there's always periods of turbulence. Like, let's remember early April, the market went down like, what, 10% in a day, or went up 8%. Like, that first week of April was like,
It was wild.
and now it's behind us. Now the S&P's right back where it was, and we're,
Yeah, but it definitely feels like it's kind of teetering here. Like, if it doesn't break above here, I wouldn't be surprised to see a very volatile late summer.
yeah.
The S&P.
It's inevitable. Like, there's always going to be volatility. Things don't go up in a straight line.
I just don't think we end the year here. I think we end the year lower. That's just
Yeah.
my thoughts. Don't
Yeah.
hold me- Well, you can hold me to it, I guess, if you want
Yeah.
to. We can have that conversation later. But
Yeah.
I just don't. I don't know. It kind of feels like this big bounce. There was a lot of retail money coming in, buying tech again, but I don't know how much longer that can take. So, especially with the repatriation of capital going back to the home countries. So, much like this train heading to Brussels or wherever it's going. So, Paul, thanks so much for your time. Good to see you once again. Always look forward to having these conversations here, and like my favorite train station in the entire world. And looking forward to the next one.
Thank you.
All right.